This is Nightly Business Report with Bill Griffith and Sue Herrera.
Economic test. New reports show the consumer is strong, but businesses are pulling back, and that could cloud the outlook for growth.
Tug of war. Johnson & Johnson sees profits spike, but investors latched onto the growing number of lawsuits, and that pushed the stock lower.
Netflix effect. It's not only changed the way we watch TV, but also the way companies advertise. Those stories and much more tonight on Nightly Business Report for Tuesday, July 16th.
And good evening, everyone. I'm Rahel Solomon, in tonight for Sue Herrera.
And I'm Bill Griffith. We certainly welcome you aboard.
Thank you.
Rahel, let's get to this tonight, shall we? You know, for a while, the stock and bond markets have been focused on three things: trade, the Fed, and corporate earnings. And today, all three issues collided. First, President Trump revealed that the U.S. and China still have a long way to go before the two countries reach a trade deal. And he warned once again that he's ready to slap tariffs on another $325 billion of Chinese goods. Second, a new report said that retail sales increased more than expected in June, an indication that the consumer is strong. That could change the calculus for the Fed and the likelihood of rate cuts this year. And third, earnings reports released so far have shown that consumer spending is strong, but business spending is slowing down. New reports like these can often change a long-held outlook for growth. So we asked Steve Leisman to put together a real-time assessment of the economy. And that's where we start tonight.
While everyone seems to be expecting the economic party to wind down or even end, no one seems to have told the U.S. consumer. The government reported June retail sales today up a strong 0.4%, beating expectations on the street. Consumers spent less money on gasoline, but plowed those savings into clothing and furniture purchases. Auto sales also did well, and internet sellers did a brisk business, seemingly at the expense of department stores. All this shored up views on the second quarter with the CNBC Rapid Update, the median of tracking estimates for GDP on Wall Street running at 1.8%. It's a slowdown from the 3% of the first quarter, but well above the worst fears that accompanied the beginning of the quarter and right about trend growth. Still, Fed Chairman Jerome Powell, in a speech Tuesday, continued to telegraph a rate cut coming from the Fed, as did Chicago Fed President Charlie Evans. In a CNBC interview, Evans said he was concerned about slowing global growth, the trade war, and inflation running below the Fed's 2% target.
With the most recent nervousness, I'd just say, I think that a little more accommodation would be helpful for ensuring that we confidently get to 2 and above 2%. I really think that 2.25 or a little bit more than that would be about appropriate for our economy and monetary policy. At this point in the economic cycle, we're 10 years into an expansion, and if we're ever going to be above 2% during this cycle, you would think this would be about right.
So consumers have enjoyed strong job growth and decent wage growth, and now they're likely to get a rate cut soon from the Fed. Doesn't seem much like the party, that is the economic expansion, is ending anytime soon. For Nightly Business Report, I'm Steve Leisman in Chicago.
So what happens when consumer spending is strong and business spending starts to soften? Mark Zandi is the chief economist at Moody's Analytics. Mark, thanks for being with us this evening. How do you explain the disconnect between the strong retail spending and the consumer spending? And the business spending, excuse me.
Right. Well, businesses are nervous. Business sentiment is way off from where it was this time last year, and that's because of the president's trade war. That has made it's unnerved businesses all around the world. Pick your survey. The Duke University runs a survey of CFOs here in the United States. 2/3 of those survey respondents say that we're going to have a recession by the end of 2020. So businesses are just very nervous about the trade war. But as a result of that, they're pulling back on their investment, but they have not pulled back on their payrolls, their hiring, where they're still adding to jobs. Unemployment is still low, and that's what consumers care about, that they have a job and that unemployment's low. So consumers are fine, just as long as businesses don't cut hiring.
Right. I mean, we see here that you call the economy fragile, but it depends on which sector of the economy you're looking at. So again, what's the Fed going to do with this? Does this mean fewer rate cuts if we're going to get any this year?
I think the Fed will cut rates. I think the economy broadly, add it all up, the positives and the negatives, it's still fragile. I mean, Steve was talking about 1.8% GDP growth. That's probably below the economy's potential. So what that means is if we stay here for very long, job growth will slow to the point that unemployment will start to rise and unnerve consumers, and that'll be the fodder for a recession. So I think the Federal Reserve desperately wants to avoid that, wants to get growth back up above 2%. And so that means that they're going to cut interest rates, and they're going to keep cutting rates as long as this trade war is going on and as long as growth is below potential.
Mark, is it possible to know what's a better indicator of the economy? Is the consumer right or are businesses right?
Well, generally, business confidence, if you go back and look at history and look at recessions over the last, say, since World War II, the last 10 recessions, business confidence tends to lead consumer confidence. So businesses, they're much more sensitive. They're on the ground. They're buying and selling. They're changing their prices. They have a real feel for what's happening. And so once business sentiment starts to go and they start to pull back, then if they ultimately curtail their hiring and unemployment starts to rise, then consumers follow. So the first, actually most interesting, it's investors that go first, and then it's businesses, and then finally it's the consumer. The consumer is the last to really figure it all out and the last to lose faith in the economy and recession ensues.
Until then, the consumer continues to spend. All right, Mark Zandi with Moody's Analytics, thank you. We appreciate it.
Thank you.
To Wall Street now, where stocks pulled back from those record levels we saw yesterday, in part because of those trade comments from President Trump that we told you about earlier in the program. The Dow Industrial Average fell just 23 points. We're at 27,335. NASDAQ was down 35. The S&P was lower by 10. The push and pull in the market today was driven largely by earnings. Three of the nation's biggest banks topped profit expectations. But investor reaction to those results from Goldman Sachs, JP Morgan, and Wells Fargo was mixed. Goldman Sachs shares were up because its growing loan business pushed net interest income up by almost 40%. That business, however, is threatened by trade tensions and the possibility of interest rate cuts. Goldman's profits and revenue both topped estimates, but both were down from a year ago. Profits fell by 6%. Consumer businesses were relatively strong at JP Morgan Chase, too. Profits from loans, up 7%, were a big reason the bank's overall second quarter profit jumped by 16%. But, and it's a big but, interest rates were on hold, which means loan growth slowed, and any interest rate cut by the Fed will put even more pressure on the bank's loan portfolio. Wells Fargo's profit was up even more, about 20% from a year ago. But revenue was flat, and like JP Morgan Chase, net interest margins fell. That's the difference between the amount of the loan and the amount of interest that the loan brings in. Margins are down in part because homeowners are refinancing again, making their mortgages less profitable for banks. And tomorrow we'll get quarterly results from Bank of America, U.S. Bancorp, and PNC Financial Services.
The grounding of Boeing's 737 MAX did not have a big impact on United's bottom line. The carrier reported better than expected profit and revenue, and that was thanks to strong travel demand and higher fares. It also raised the low end of its profit forecast for the year. Taking a look at the stock, it did rise slightly in initial after-hours trading. Phil LeBeau joins us from Chicago. Phil, good to have you. So the grounding of the 737 MAX did not affect the carrier in the most recent quarter, but what about looking forward? What about future quarters?
Great question, Rahel. We don't know, and we don't know the exact impact of not having the MAX in the second quarter had on the results for United Airlines. They're not breaking those out, nor will they say the expected impact for all of 2019. But one interesting note did come out in the earnings release. The company has agreed to buy 19 used Boeing 737-700 airplanes, with some of those deliveries starting in December. Why is this important? It's important because they may not have the MAX back until the end of this year. And even then, some people are saying, look, it may not be until early next year. But they have capacity growth plans. They want to make sure that they have the seats in place for that.
I'd like to see them going out and kicking the tires on those things. So United is seeing strong demand here in the U.S. What about international routes right now, Phil?
That's a good question. They don't talk about it specifically in the earnings release. We'll have a chance to talk with CEO Oscar Munoz tomorrow morning, and that's going to be one of the primary questions. We've heard from other airline executives that they have seen what they term as softness, particularly in Asia or around China, with all of the trade tensions that have been developed. Now, that doesn't mean that it's falling off of a cliff in terms of demand, but it is an area that's going to get a lot of questions, not only from us in the media, but also from analysts when they talk with CEO Oscar Munoz tomorrow.
Okay, Phil, we know you certainly will ask. Thank you. Phil LeBeau in Chicago for us.
Elsewhere, Dow component Johnson & Johnson reported better than expected earnings and increased its guidance, but that wasn't enough to push the stock higher. Meg Terrell explains why.
Johnson & Johnson is the world's largest healthcare company. It sells everything from prescription drugs to Band-Aids to tools for hip and knee replacements. And in the second quarter, its profit and sales beat Wall Street's expectations. But the stock fell. That may be because investors' focus is elsewhere. Legal battles around baby powder and opioid painkillers.
It's still pretty difficult for investors to understand the implications of some of the legal liabilities that they may face with respect to talc and also with opioids.
Closing arguments took place yesterday in a case in Oklahoma where state attorneys claim Johnson & Johnson contributed to the opioid crisis.
The defense blamed everyone except themselves, for causing this crisis.
A decision from the judge is expected later this summer. In an interview this morning, J&J's chief financial officer disputed the claims.
We readily admit there's an opioid epidemic that needs to be solved by many parties, and it has to be multifactorial in terms of its solution set. But here the facts don't align to the claims that the state is making.
And J&J's stock fell last week on a report the Justice Department has opened a criminal investigation into whether the company lied to the public about the risk of asbestos in its talcum powder products, going back to the 1970s.
We're complying fully and cooperating fully with the Department of Justice. It's an astute organization. I'm sure once they go through the facts, they'll come to the same conclusions that the company acted responsibly and that the product is safe.
But the uncertainty leaves investors unsure, said Jefferies healthcare strategist Jared Holtz. That makes a stock that was considered a defensive, steady investment less so.
The quarter, netting everything out, very much in line. I think the legal overhang is the consideration in terms of buying or selling the stock into the second half.
Today, anyway, investors sold. For Nightly Business Report, I'm Meg Terrell.
As we've been reporting, one of the biggest concerns for the market is the slowing global economy, and that's starting to show up in the results from industrial companies. Bob Pisani is at the New York Stock Exchange.
Earnings season is officially underway, and while it's still in the early innings, there are some signs that the global industrial economy is a bit slower. Just look at a handful of companies who reported in the last few days. So today, Arrow Electronics, which makes electronic components and semiconductors, they pre-announced weaker earnings for the second quarter. They cited deteriorating demand conditions, particularly from Asia, and an inventory correction. We heard similar sentiments from companies last week. Another semiconductor company, Vishay, pre-announced June sales well below expectations. They also noted an inventory correction and pricing pressures. Also, Fastenal, which makes tools, motors, fasteners, they sell to a number of big multinational companies around the globe. They also reported lower revenues and lower gross margins last week. They blamed higher costs, largely related to trade wars and tariffs. Finally, BASF, this is the world's biggest chemical company, they also lowered guidance last week. They cited the trade conflicts, weak global industrial production growth, and a broader downturn in the global automotive industry. So beyond just the corporate speak, Federal Reserve Chair Jay Powell also echoed global growth concerns. Today in a speech, he acknowledged weakness in the manufacturing sector. He said that manufacturing sector has been weak since the beginning of the year, in part weighed down by the softer business spending, weaker growth in the global economy, and concern about trade tensions. Now, we'll see whether the story remains the same for other semiconductors and industrial names, including manufacturing giant Honeywell and chip maker Taiwan Semiconductor. Both of those will report results on Thursday. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Oil prices fell today after President Trump signaled progress with Iran and said that he was not looking for regime change in that country. During a meeting of his cabinet at the White House, Secretary of State Mike Pompeo said that Tehran was prepared to negotiate on its missile program. And those comments pointed to an easing of tensions, which then sent oil prices down by about 3% in today's session.
And time now to take a look at some of today's upgrades and downgrades. Dow component Home Depot was downgraded to hold from buy at Gabelli. The analyst cites the stock's valuation. The firm also notes that the current stock price reflects above market growth over the next 3 years. The stock fell a fraction to $217.26. Parker Hannifin, meantime, was downgraded to sell from neutral at Goldman Sachs. The analyst cites a slowdown in the industrial sector and also a constrained balance sheet. The price target is $150. Now, despite the downgrade, the stock rose about 2% to $171.04.
And still ahead, in the hot seat, lawmakers come down hard on a sector that has helped drive this market higher.
And it was a rough day for big tech on Capitol Hill. Facebook, Google, Amazon, and Apple all found themselves the target of lawmakers who, as you know, are increasing the pressure on some of the nation's most prominent companies. Elon Moy was there.
First up was Facebook, testifying before the Senate Banking Committee on its new cryptocurrency called Libra. Senators on both sides of the aisle pressed Facebook on exactly how it would work, who would regulate it, and how Facebook plans to make money from it. Republican Senator John Kennedy accused Facebook of trying to control the money supply, while Democratic Senator Sherrod Brown compared the company to a toddler playing with matches. But ultimately, lawmakers said their concerns come down to trust.
Trust is something you earn, and Facebook certainly hasn't earned it.
What kind of faith do we have in Libra?
Can we agree that a banker should be trustworthy?
I don't want to get into the technical stuff. I'm talking about the trust issue.
Mr. Chairman, I wish we could trust Facebook. It's pretty clear there's almost nobody in this committee that does.
Facebook executive David Marcus defended his company's record. He said Libra will not compete with retail banks or central banks, and that it would not share information with Facebook. Instead, he pledged to work hand in hand with authorities.
Getting this right means addressing these concerns in full and ensuring that there's proper regulatory oversight for this project.
Over in the House, the spotlight was not just on Facebook, but also Google, Amazon, and Apple, as officials from all four companies testified before the House Judiciary Committee. The focus of that hearing was on innovation and entrepreneurship, and whether big tech companies are not only squashing the competition, but keeping new players from getting into the market altogether.
In other words, this hearing isn't just about the companies before us today. It's about ensuring that we have the conditions for the next Google, the next Amazon, the next Facebook, and the next Apple to grow and prosper.
The companies argue that they actually encourage innovation, not stifle it, and they say they face intense competition for their products here at home and around the world. One thing these hearings made clear is that the battle between big tech and Washington is far from over. For Nightly Business Report, I'm Elon Moy in Washington.
So when all is said and done, what kind of regulations and/or restrictions are we likely to see imposed on these tech giants? Joining us is John Freeman. He's technology analyst at CFRA Research. John, good to see you. Thanks for joining us tonight.
No, thank you for having me.
You think it'll be modest, to use that term. What do you think is going to happen? Describe it.
Yeah, so I think the first sort of effort will be modest. There'll be some sort of oversight, I think, is the most likely outcome. But the scary thing is that they are writing legislation, or they're considering writing new legislation specifically for social networks. So this is not as much an antitrust issue, a classic sort of FTC antitrust issue, as it is, curtailing the political power and influence that particularly Facebook has. Because I think Facebook really has kind of, separated from the pack in terms of the scrutiny that legislators have on them.
And would you say that other players in this space are watching sort of how Facebook reacts? Because as you said, it does seem like regulators are honing in on Facebook specifically.
Yeah, I think they're watching, but I think the thing about Facebook is it's relatively new to the lobbying game. Google, Apple, even Amazon have been doing it a little bit longer, and I think they're a little bit better at it. I think the Libra announcement, just the timing of it, now you're going to give, nefarious actors the ability to, manipulate the next election anonymously with money that, that they don't even have to launder. I mean, you can see the political engine getting under there that way. And so I think that's one of the reasons why Facebook has sort of more scrutiny on it.
Now, we all know that these kinds of companies, the companies that have been at the forefront of technology, cutting-edge technology for the last several years, have been leading this market higher. Now they're getting this scrutiny from Washington.
Right.
Does that cap that growth, do you think?
Well, I think for Facebook, I think it's built in, or the light oversight, some sort of light regulation is built in. I think it's maybe even built in a little bit for Google as well, but perhaps not the more disastrous outcome of, say, for example, rewriting the 1996 Communications Decency Act, which means that both Google and Facebook would actually have to be responsible. They could be liable for, they could be liable for libel, right? They'd have to actually be responsible for their content, which wouldn't be practical. But that's kind of the sort of the worst case scenario. And most of the investors I talk with have kind of built that in, but they are concerned about regulation. That's the questions that come out, is mostly about regulation with Facebook and Google right now.
Indeed. John Freeman with CFRA Research. Again, thanks for joining us tonight.
No, thank you. Take care.
Charles Schwab beats the street, and that is where we begin tonight's Market Focus. The discount broker was helped by nearly 400,000 new customer accounts last quarter. The firm now has 12 million active accounts. The stock was up more than 3% to $41.63. And in an SEC filing, KeyCorp said it discovered fraud that could cost it $90 million. The bank says the fraudulent activity involved one of its business customers, and it happened at the start of the third quarter. The company believes it was an isolated incident and says it's working with law enforcement. KeyCorp fell more than 1% to $17.38. CBS and Viacom reportedly set a deadline to agree on a merger. CNBC says the media companies have settled on August 8th. Also on that day, both CBS and Viacom will report second quarter earnings. CBS rose a fraction to $53.51. Viacom fell more than 1% to $35.72.
Canadian Pacific topped analyst estimates thanks to an increase in oil, chemicals, and plastic shipments. Railroad operator also lowered its costs for the quarter. The stock rose nearly 4% today to $246.27. Domino's reported the slowest same-store sales they've seen in 3 years as it expands its store base and faces increased competition from food delivery services. Company has increased the number of locations as a way to compete with those companies, but analysts say the expansion may be cannibalizing sales at existing locations. So shares fell more than 8% today to $246.54. And after the bell, CSX reported lower than expected earnings and revenue. Company saw an increase in its merchandise shipments like vehicles and apparel, but that was offset by declines in its container shipments. Shares initially dropped in after-hours trading tonight, but they did close the regular session up more than 1% to $79.55. And late today, the Department of Justice asked an appeals court to pause its antitrust ruling against Qualcomm. About 1 month ago, you might recall a judge ruled that Qualcomm illegally suppressed competition in the market for smartphone chips. Shares rose in initial after-hours trading on that news, closed the regular session at $75.67.
And coming up, no ads, no problem. Companies are using a different marketing strategy to target binge watchers. IKEA is shutting down its one American factory. The company plans to move operations to Europe due to raw material costs that it says are higher here in the U.S. IKEA says shifting the work to Europe and importing the goods will make its furniture in North America more affordable. The Danville, Virginia plant employs 300 workers.
Netflix reports earnings tomorrow, but tonight we're going to take a look at how this company has changed the way we watch TV and the way companies advertise. Here's Julia Borston.
Netflix's roughly 150 million subscribers binging with no commercial breaks has pushed advertisers to find new ways to reach viewers glued to ad-free platforms. One example, New Coke. It's featured in Netflix's original series Stranger Things, with Coca-Cola bringing back new limited edition Coke cans for sale, turning the company's infamous failure into a new marketing opportunity. The streamer says none of the many brand mentions in Stranger Things are paid for, but they offer Netflix valuable promotion.
In today's world, the streamers have adopted that old movie, technique and are working directly with brands who get product placement integration, but then they'll also promote the show in advertising, on digital, on their social channels, et cetera. So that's building an audience for the show, and that's what the streamers want.
Promotional partnerships also happen off-screen. For Stranger Things, Baskin-Robbins created 8 flavors and collectible containers tied to the show for its largest partnership and its first with a streaming platform. And it's not just Netflix. Hulu was paid to feature Miller Coors beer in 10 episodes of its Into the Dark series. Hulu says brand integrations work better than 30-second spots on the platform, delivering a nearly 90% increase in purchase intent among viewers and a 75% increase in brand awareness. And to break through the clutter, some big brands are returning to the original TV ad model, paying to produce shows and documentaries in an effort to reach consumers with content rather than the ads that interrupt it. Procter & Gamble is sponsoring a National Geographic TV series on efforts to combat extreme poverty, looking to align its products with efforts for good.
Brands like P&G and others are going to benefit from having those. It is expensive. And that's really where the challenge comes in, is the expense not too high such that the return is achievable.
Johnson & Johnson financed a documentary about nurses in the early days of the AIDS epidemic, the brand hoping for a halo effect from the film's message of compassion and rave reviews. For a Nightly Business Report, I'm Julia Borston in Los Angeles.
And before we go, let's take a final look at the day on Wall Street. The Dow fell 23 points, the Nasdaq was down 35, and the S&P 500 was lower by 10. And that is Nightly Business Report for tonight. I'm Rahel Solomon. Thanks for watching.
I'm Bill Griffith. Have a great evening. See you tomorrow.